Hi everyone, welcome to Settlements Property Meet, March 2025. And for me, it's the month of Ramadan, so hopefully I'm still up to speed on it. Jeroen, one of the regulars, this person, your guide goes for construction. You're asking about some of the projects that you're doing about new builds, right?
Yes, the VAT impacts on new builds, because a lot of people are really confused about what they should be charged, 20%, 5%. Yes, but it's the main residence, so people that have read up in the past about VAT,
They don't know.
Yeah, but it's an essential thing, so why,
So there's so many different variations in construction and obviously building for entrepreneurs, whether you're a developer or doing the construction. The builders struggle with this, the developers struggle, and they always don't understand it. So if you're building a new property, what I mean by that, you've got a piece of land and you're constructing it, it's 0% from the builder to you. So that means pretty much the labor and the materials will be 0% VAT. However, as always get advice. For example, professional fees like architects and things like this are still 20% of VAT. However, if you are smart and you're an entrepreneur like a developer and you're dealing with it, if you structure this correctly, you can get huge benefit. I would always recommend for developers of new builds to go on an invoice basis, for example, or accrual if you're losing the technical term. And the reason why I say that is even before you pay the invoice, you can claim the VAT back. And that is so important. And if you do monthly VAT, huge amount of value, that's how you structure this business. I think there's another question you were asking on some of the synergies.
More on that, to be fair. If you've got a sizable project, and on a new build, you normally have a sizable project.
Yeah.
I mean, I'm talking projects, $500,000 upwards, easily going into $1 million.
Multiple millions.
You're running across multiple months. What you would typically have, you would have an invoice for an engagement, so a deposit to basically tie you into the contract to get going. Right, so you're providing a bit of cash flow to a builder to secure his materials, to secure his labour. Obviously, that is a VAT element on that obviously can be claimed back. But the thing is as well, you get your monthly valuations. So, together with not just you as a client, but particularly as, like, from an architect perspective, an architect is supposed to administrate the contract for you. So what they do, they come round once a month with the builder on the project, and they walk through the whole project, and they basically say, of your massive to-do list, put it in a simple terms, your scope of works, of all the things that you should have been doing, from digging a hole in the ground to basically handing over the front door keys, there is, let's say, 6,000 steps. How many of those 6,000 steps have you actually taken in this last month? Okay, and that's what you're going to get paid for.
I think you made a really good point. So Jeroen is talking about cash flow management and using VAT to fuel your cash flow. So if you've got monthly VAT and you're doing a drawdown, that's what Jeroen's talking about, and you have to hit certain requirements, you can utilize that to draw down and reclaim your VAT before you physically obviously paid, depending on your terms that you've done with your suppliers. That's how you get a good advice and you manage the project, because cash flow kills the project bigger than whether you're making a margin on the sale. And that's what a lot of people struggle, and a lot of construction people struggle, a lot of property developers struggle, and as you're going up the scale, especially do multi-million pound GDVs, I've got quite a few clients who do multi-million pound developments. And their money is always struggling with the cash flow when they're going to get the drawdown. Have they met the requirements?
And that's where you'll notice on the seasoned people that have done these kind of things before, what they actually do, they make sure that they work with their architect, with their builder, that they know before they even get going, that they know the scope of work, that they know exactly what they want. They know even down to the socket cover what they want. Because if you're going to make those decisions later, you might end up with a hiccup, so you get variation orders, so you're going to end up changing things. Because if you want to go for underfloor heating and you've got the whole job spec'd for radiators, that means people are going to lose out, you're going to end up delays, and with delays, you're now going to basically, yes, you can reclaim your VAT on certain items that you bought, but guess what? In the meantime, you're lacking in progress, so when next month's claims come through, you're actually not having a sizable claim. So
It's a
that's
cash
where
flow.
delays are going to cost your project.
The cash flow management is so critical to property developers, and I know Jeroen works with a lot of property developers because he does a lot of big constructions. It drives the value, so you must have good financial support, good systems, and they must be helping you manage with a forecast based on cash, right? What is in your bank account? What are you paying? What terms have you got? So you can stretch out the cash flow because they run out of cash, and you have CIS, the cost of labour, right? I always say to him, try to do it monthly rather than weekly. It'll save you on the returns, and you can manage cash because you've got to pay HMRC monthly then, based on the money that you paid your subbies. And it's things like this that people just don't understand. Having good terms with suppliers, because that can be the difference. Because if you don't, what happens with the developers is they end up failing on the project because they haven't thought this through. They run out of cash and they can't finish the project, and that's where they become distressed. And then a switched-on developer comes along who has got the financial support and the right team, the right suppliers in place, and they take over the project.
Exactly.
And that's the difference. But people just don't think about this, and they think, oh, it's magically happening. That is why they make the good numbers. I always say, I don't know what you reckon for a lot of developers, but I always say on GDV, I know some people do it on cost, I always say to them, start with 40% margin on GDV. People are like, Z, really? If you don't start with 40 to 50% and get a really good deal, by the time you've done it at the end, with experience, it will end up 25 or 30%. If you start at 25, 30%...
You are naturally through a project, you're going to hit leakage, seepage, whatever you want to call it. You're going to lose meat off the bone.
And also, it always takes longer. Certain things getting signed off always takes longer. Therefore, financing costs are kicking in longer. So it ends up being 25, 30%. But if you start at 25, 30%, believe it or not, most of them end up with 10, 15%, and they think, what's the point?
Because at this point in time where, and I know people don't like talking about Brexit anymore because it's been 5 years. Yeah, but we are now 5 years away from what originally started as being Brexit, as like, it'd be quick over and done with. You're now having a workforce that is not being replenished from the outside anymore because there is no incentive, to be brutally honest, there is very little incentive from European workers to come and work over in the UK.
I think Jeroen has raised a really big point, and I don't care what people's views on this. This is my view. Someone who sees the numbers, helps developers, not just talks about it, does it. There's a big difference. Two things that have really hit home is cost of labour or lack of labour due to cost of labour, and Brexit has affected that. And the second is, believe it or not, materials, and that is this dodgy war in Ukraine, right? Whatever your views are, it's cost the labour up. Those two factors have changed the whole scope of how much property development costs, whether you're doing commercial conversions to resi, whether you do new builds, whether you're converting to HMOs, all of this now has become more expensive. And therefore, if it's become more expensive, you need to manage your finances more effectively and have a bigger margin factor.
Whether it's your plasterboard, whether it's your timber, i.e. your CLS. I mean, it's great.
For the audience, what do you mean by UCLS?
CLS. It's like basically your box standard timber battens, your joist and stuff, It's supposed to all come from Canada, and it's great that the Americans are not going to take that much because they obviously don't want to pay the extra 25%, which we're more than
Sorry
happy.
if you're a Trump fan.
We're more than happy to have the timber over here because we desperately need it. The problem is because the Swedes can't grow them that fast, those trees. When it comes to it, you can only work with what you got, and
it's huge.
I mean, it's going to be great, obviously, when there is finally a ceasefire to hold on to in Ukraine. But that's obviously going to give a different perspective on the market again, because that's once again going to draw on labour and it's going to draw on materials in the other side, because that's all going to be, that's still going to have an effect, even though you're thousands of miles away.
I think Jeroen's highlighted such a big thing: planning, understanding what the resources required, getting a cash flow plan, understanding, putting flexibility, contingency in is so important. And you make the money, believe it or not, on two parts: on the purchase, of the land and the deal and on the exit. But the exit is determined on what happens on the purchase and the journey to the exit. So don't always bank on the exit if you didn't get the purchase right, if you understand what I'm saying. Jeroen, you're a star as always. Jeroen, helping a lot of developers right now. Definitely a person to bring. Tap him in onto the post, wherever you've seen this on the socials, and contact with him. He's got a good team behind him, and I've definitely seen a few people going his way to help them construct their projects and make those big developments that are required and make the value, because now is the time to get value in the economy. Jeroen, thank you so much.
Thanks so much. Cheers. Thank you, guys.
As everyone knows, St. Albans Property Meet, March 2025. We've got Grafton.
The finance best man, Barber.
Don't ever forget that. That's his trademark name. He's going to give us a finance update in March 2025 when a lot's going on. You were mentioning to me earlier, spill the beans. You're saying semi-commercial. Just explain to the audience what you mean by semi-commercial and why lenders are loving them.
Yeah, there are a lot more lenders in the market now for semi-commercial. Semi-commercial is where you have a retail unit downstairs, flat upstairs, and now you... Previously, a lot of lenders didn't consider the retail income as part of the calculation. So what they wanted was just, and so it limited people on what they can buy, the value of the property.
So on this one, is this post-PD, permitted development, and people have already done a title split, or they're about to do a title split?
They can leave it as a retail.
Yeah.
And still, no title split.
On one freehold.
One freehold, still have it as a retail.
Yeah.
Residential upstairs, commercial downstairs, and both incomes are considered now, which mean they can borrow more because the income is sufficient now to service the lending.
The reason why I always bit skeptical around the structure of that is from a tax perspective rather than a financing, is because there can be issue because of VAT. Because when you buy normally it would have been commercial all uppers and the shop below, you may have been opted to VAT. And you may have registered for VAT to claim the VAT to convert. And if you then have residential rent come in, you've got a VAT problem. Right? Because it becomes partial exemption VAT. You have to then agree with HMRC how you do the VAT. Good luck with that. And that's why people come and see us and do something called a group structure and split the title. And then they have an uplift in value.
Exactly.
They draw the money. So let's use an example. People love numbers. They go and buy, say they bought something for, say, 400 grand. They spent 300 grand to make it into a resi up the tops, kept the commercial. So that's 700 grand, it's worth $1 million now. To pull the money out, they need to do a title split. And they want to have to not get the clawback on VAT. And they want to take advantage of the capital allowances that they got in the commercial, which this allows to do all that. So you split it. And if they're really smart and they've got a switched on account tax advisor, they can take advantage of the SAS pension and not just be a bank as well. So there's loads of different values, but it's making sure you combine it correctly with the financing.
Exactly.
Because the financing people obviously are a bit careful where you said you got a title split, but you haven't split it out of the company. And I've seen the odd ones, believe it or not, have this. I don't know how they got it through, because normally the lawyers don't allow it. And the financing people said they're going to call in the money. So I've had a couple phone me recently about this.
Oh, okay.
Yeah, because they've done a sort of title split, but they haven't formalised it. And I'm like, and now the lender's clocked on and said, hold on land registry, you haven't done this, how can we give you financing against the different components?
Well, as I say, we've got some clients who haven't even done a title split. It's just one property.
I assume it wasn't VAT registered.
Don't know. Okay. But one of the things I say to them is always talk to your accountant or find a good property accountant.
Probably that's right. So you help them finance that, and they use what Grafton's talking about, the rent as the bottom of that to help get a big more financing. Would that be a commercial finance on that?
So they would have a commercial lease on it. And but it can be a standard buy-to-let.
Wow, on the commercial as well? Because the
buy-to-let.
commercial finance tends to be more expensive. The audience probably thinking, what are we talking about? You've got residential finance, and Grafton will correct me being the expert, and then you've got commercial finance. Commercial finance tends to be more expensive, but you tend to have bigger numbers because you're doing it on a different basis.
Correct.
So you're saying that you can do both?
You can do both.
Wow, you've heard that here. Grafton helps facilitate both options depending on your circumstances and what income you're generating.
Because there's a lot more specialist lenders out there now than there were 5 years ago, 10 years ago.
Wow. And what was the other one that you were mentioning?
Sharia lending.
Wow.
I'm getting a lot of requests now for Sharia lending.
Okay.
And that could be either bridging lending or buy-to-let
What
Sharia
type
loans.
of Sharia lending? Because the audience will be asking us, as I'm celebrating Ramadan, the fast is open, feeling it, right? Sharia lending, what type of Sharia lending are you doing? Because there's slightly different types of concepts. Have you got any specific or?
No, not really. I haven't got any specific ones as long as there's no interest being charged.
It's the method that they do it.
Method that
and
they do.
also affects the tax, the special tax rules for Sharia lending. So we've had some people do that because what they do, instead of charging interest, they charge rent. And they become and they become partial owners, the institutional lending.
Correct.
That rent is actually treated like interest in accounts. Yeah. Just for the knowledge on there.
So yeah, you're right there. So with some of them, especially like on the buy-to-lets, they become sort of part owners. Yeah. With the bridging, not so much. It's just the way that they calculate the fee.
Yeah.
And it's not interest, but it's sort of a profit. But the advantage of doing it like that is that the profit isn't compounded. So you sort of save some money, whereas the interest is compounded.
Yeah.
And so it's a lot more costly because with the standard loan, the rate is charged on the gross.
Yes.
Whereas with the Sharia, it's charged on the net. So
Well, they do
the profit
the rent.
element of
Yeah,
it,
they do
etc.
the rent.
And so you can save a couple £1,000
So-
depending on how it's structured.
How many years? Two things. One, what's the interest rate on traditionally on these kind of Sharia mortgages, Sharia compliant mortgages that you see? What kind of interest rate are we looking at?
The bridging rates are more or less the same.
Wow, same as
1%
conventional?
or just a little less. Depends on the client. If the client is low risk, obviously the interest rate reflects that.
Number two, what's the loan to value they're giving?
Loan to value could be 75.
Wow,
Even
if it's
80.
buy to let and commercial up to 70? Wow. And number three, what terms are they giving on these mortgages?
For terms, for commercial terms, 10 years.
10 years, because there's a repayment element, isn't it?
Yeah.
You can't do just rent only or interest only on these belt mortgages, right?
That's it. And for residential, it can be up to 20 years.
Wow, they're allowing it to go that far. But then by 20 years, there's repayment. Obviously, you clear it. It's just got to factor in from a cash flow perspective. When you have a conventional interest-only mortgage, all of that's been deducted, right? But when you've got a repayment, remember that partial's going, so you're getting taxed on just the rent element, not the repayment. And therefore, you've got to factor that you need more cash flow to be able to deal with these mortgages. But ultimately, they may end up costing you less and you own the asset. I know for an inheritance tax, I know I'm throwing it out there, it's not the best way, but from a financing perspective and an ownership and a Sharia compliant perspective, it's much better, isn't it?
It's much better.
Wow,
And
so you've got huge...
again, and I always, because I don't know too much about the tax side of it,
Yeah.
whenever I do these lending for clients, I say to them, you want to know anything about the tax savings and everything, speak to a property tax person. Not just an accountant, but a property accountant.
If you know one,
If you
right? The Sharia...
And if you don't know one, I know one who I can refer you to.
The Sharia bit is quite a bit more complex. You have to look at
Yes.
the type of Sharia mortgage because the Labour government actually did change the rules to stop the double taxation. But there is one type of type of lending that they don't have that. Because what you're actually doing is you don't own the property, you're getting partial ownership.
Yes.
And they've got special rules depending on which one that you don't get a stamp duty hit again.
Yes.
But there's one that you actually do, so there's a double taxation. So you've got to be careful which type of Sharia scheme you're in and how comfortable you're with it and do the numbers stack up. And the big one, do you know someone like the best man for finance? Grafton here. Grafton, thank you so much.
Pleasure.
Don't you love the value? Another expert of Sharia compliant mortgages and semi-commercial in this episode. As everyone knows, one of the co-hosts of Saleman's Property Meet, Craig Shepherd. Thank you.
Thanks for coming again.
Craig, the notorious smelly house that went viral last year on the post. What you were saying, you said there was a key thing that you wanted to give insights to the audience about.
Yeah, top networking tips. So this is the thing. You know, it's the end of the evening. Everybody's just finished. We've had a fantastic day here today. About 60 odd people turned up today. So great networking things. But I was rushing here because I had to travel up from Minehead and I didn't have my business cards, but it's not a problem because I've got my phone with me.
Wow.
And even if you run out of power on your phone, here is a little tip. I have a QR code on the back. You can scan that QR code and that takes you to my Linktree page and it's got all of my contact details. So if you attend a networking event and you forget to bring your business cards, literally you can buy these cases of Amazon with a clear backing, print a QR code, and then it can take you to a Linktree page or your LinkedIn profile page. You can download the QR code and you've always got a means of being able to connect with people.
Wow. This is the value that I'm talking about. Last one. People were asking about the smelly project house in Hemel.
It doesn't smell anymore.
It doesn't smell anymore. When did you do it, first of all?
So it's all during the last 12 months.
So as I said, the person was asking the question, I'm following up. Here, you heard it, in the last 12 months. This is March 2025. So it's real. And it ended up...
Yeah, I bought it 12 months ago, and then I was renovating other properties, so it didn't start the refurb for a while. Anyway, we did the refurb and got a new tenant in there. The refinance was literally organised just 3 weeks ago.
Wow. And he pulled all his money, a brr, and it's now valued at 400,000.
400,000.
And
So
you
we
pulled
bought
out
in for 300,000. So it was 257,500 was the initial purchase price. I did a lot of the refurb myself. We incurred extra cost because when the electricians were checking the electrics, they called me up and said, "You've got to look at this bathroom fitting." So the wires were literally hand twisted together.
Wow.
No insulation tape. Do you know what they used? A Band-Aid plaster. And as soon as I saw that, it's like, no, I can't trust any of the electrics in this house. So we incurred more costs, full electrical rewire. Literally every single cable got ripped out because I was going to keep this property. I wanted to make sure it's proper safe. So that cost me about £7,000 on the actual electrical refurb. It's a 4-bedroom townhouse.
Because all in, you said it's 43 plus stamp, everything.
Yep.
You got it in 300, and now he's got 100 grand equity. What's the financing costing you roughly on this property?
So we get £2,100 a month rental income, and it's about just over £1,100 on the mortgage.
Right.
So it's basically £1,000 a month.
And is that interest-only mortgage you got?
Interest-only mortgage, yeah.
Wow. So now you've seen it. He was saying to you, so even if you had a bit of wear and tear and everything, you're still taking probably £700-800 home. That's after even some one-off costs.
And the return on investment?
10 grand. Well, it's good, isn't it? It's
infinite.
Massive. Well, the return of thing, but I'm more thinking about in valuation terms.
Yeah.
You've got a 400 grand property. How much net cash am I looking at?
Yeah, so it's just under £12,000 a year.
Which is that's not bad at all.
There's no money in it. It's a free house.
And you're getting free money.
Because I've recycled all of my cash. So it's an infinite return on investment. £12,000 a year passive income on a £400,000 asset that's going up in capital gains anyway. So in, say, 10 to 12 years, that will double in value.
And Craig obviously got some advice, brought in a limited company, just for you let you know. So the mortgage interest, 100% tax deductible. Section 24 does not apply.
He's the man to talk to.
Craig, thank you so much. This is the value you get at St. Albans Property Meet. I hope to see you next time.
Cheers, everybody.